There is a new terminology for the MAGA movement. It's no longer Make America Great Again. Instead, it's My Assets Got Annihilated. So I just wanted to share and document my own personal journey where I've experienced my largest single day drawdown to date in my entire investing career, where I was down roughly $28,000 on Monday alone. And of course, when you put out such figures out there, there is distinctly two groups of people. One group saying that, why are you trying to flex? Another group saying that, why do you even dare to show such numbers? And of course, when I posted on my community tab, I have somebody commenting that his portfolio actually went down by more than my entire portfolio on Friday. So this is clearly not a dong measuring exercise, so I don't have to prove a particular point here, because in fact, this is my own personal channel. I can post whatever I want to. But I think more importantly, I wanted to take this opportunity to also show you guys what I personally am going through. You're probably not alone. And just some sort of a digital archive for my future self to watch back to see how things has progressed or developed over the years. So you probably want to just treat this as some sort of a digital journal entry. Just leave it as that. Don't care about the numbers or anything. Just let me be myself. So maybe just some context as well for those of you who primarily only trade the US market. Specifically for us operating in the Asian market, we actually see both the Japanese and the Taiwanese market hitting a circuit breaker as the whole Trump tariff discussion actually deepened some of these panic attacks. And more importantly, where I primarily also host most of my portfolio positions, which is in the Hong Kong/Chinese market, the Hong Kong stocks actually suffered the steepest decline since 1997. And what happened back then in the 98, it was actually the Asian financial crisis. And in fact, there are even state funds stepping in to stabilize the Chinese share market. And over 2,000 mainland listed companies actually hit their limit down. So the Hang Seng Index, which tracks the Hong Kong market, is down 13%. The Hang Seng Tech Index, which is mainly like something like a Nasdaq equivalent for the Hang Seng, is down 17%, whereas the CSI 300 is also down 10%. So all of them down double digits in a single day. So yes, headline numbers definitely do look scary, but don't forget last Friday they were actually closed. So I think this Monday opening was kind of a culmination of two trading days stuck together as one. But that's it. I think generally speaking, we can kind of see the entire media landscape and investor sentiments starting to turn for the worse. So the main culprits, of course, in my own personal portfolio, Alibaba and Tencent, they make up, I guess, roughly 50+% of my portfolio. And then I'm slowly adding to Meituan. And I also have Moutai as one of the anchor positions as well. Just also a side note that, yes, I just couldn't resist it. I actually pulled the trigger on Meituan again. I bought one more share when the market was open earlier this morning. So my own personal portfolio, this is the current breakdown. If I were to add my cash position as a portfolio line item, it's currently sitting right under 10%. So I stand corrected. Alibaba, Tencent makes up roughly 45%, and then you have Moutai at 10%. And then of course you have your US tech companies, the semiconductor companies, and some of these other starter positions. For companies that have accumulated over the past 3 to 4 years, like Tencent, Amazon, TSM, Meta, they're still sitting on healthy gains because I actually bought them in the previous bear market cycle. But yes, surprisingly or not surprisingly, Alibaba, I've bought them much earlier, and then I've been averaging down. I'm rightfully in the red again. So when you look at some of these smaller positions that I built into the portfolio much later on, you can see that they make a smaller position, but also they are sitting deep in the red. And personally for myself, I actually do look forward, and I'm actually getting slightly excited to continue adding to them. So amidst this crazy market backdrop, Longbridge has launched an even crazier new user sign-up promotion just this afternoon, where they bumped up some of its new user perks. So for Singapore residents who have not created a Longbridge account yet, currently, if you sign up for a new account, I'm using my affiliate link down below, you can enjoy a lifetime commission-free trading for both Hong Kong and US stocks. And not only that, if you actually deposit a minimum sum of 2,000 Singapore dollars and maintain that sum for 30 days in the account, and complete 3-buy trades, you actually get to enjoy half an Nvidia share. And where is this bump up promotion? So they actually increased the 6% per annum interest boost coupon to 6 plus 8%. So that means you enjoy a 14% per annum interest coupon for 90 days. So that's also with the requirement of depositing at least 2,000 Singapore dollars. So right now for new users, if you deposit a minimum sum of 2,000 Singapore dollars and complete all these requirements, you can enjoy a $18 affiliate cash coupon if you use my link below below, 0.5 Nvidia shares worth roughly $60, and an interest boost coupon, which is 14% per annum for 90 days for that $2,000 you deposit, and that's worth roughly $70. So to add up all these new user promotion, you get a total of $148 on a $2,000 deposit, and that's roughly 7.4% on your capital. And I do know that amidst this market volatility, some of you probably park your money in high yield accounts or some of these money market funds. So where else better to enjoy this 14% per annum interest boost coupon with their Cash Plus solution for 90 days. So the sign up link will be in the description box down below, and thank you Longbridge for sponsoring this video. So given this whole Trump tariff story being the center of most news headlines, the People's Daily, which is the official newspaper of the Central Committee of the CPC, actually just published an editorial on this entire idea of Trump's tariffs. And I'll just give you a quick summary of the main points. So they said that the tariffs were expected and planned for, and they fully estimated its potential impact and are prepared for adequate response plans with sufficient lead time and margin. And the impact will actually be limited. So these were the few factors that they responded with. There was a reduced in US market dependence, where export actually dropped from 19.2% to 14.7%, and exports actually make up less than 20% of China's entire GDP. So many US product categories also have high dependencies on Chinese imports that cannot be easily replaced, at least not in the short term. So US will still have to buy from China. And lastly, nearly 85% of the exporting enterprises in 2024 also conduct domestic sales, and with domestic sales accounting for nearly 75% of their total sales. Long story short, they're telling you, don't worry, we got it handled. Now, they also put forth the point that this is a strategic opportunity for China. So they will turn pressure into motivation as a strategic opportunity to accelerate the construction of a new development pattern, promote high quality development, and economic structural adjustments. They want to boost China's technological self-reliance and to position China as a responsible great power, in contrast with what the US is currently projecting out to the world to also inject more stability into global economic development. So tariffs actually provide additional motivation to treat expanding domestic demand as a long-term strategy, the main driver of economic growth. So just a few comments from myself. I think when you read such propaganda pieces coming out from their mainstream media, I think you should always take it with a pinch of salt, regardless of which side you are on. So if the world actually gets more isolated, I think everyone will not be better off. So the dependence of exporting to the US might actually have shrank as a percentage, so those numbers are actually legitimate. But I think for those of you who actually do follow how some of these trade relationships developed over the past 3 to 4 years, we all kind of know of the phenomenon of the lengthening supply chain and who still has the largest consumption base. At the end of the day, you can't so easily just replace who is the ultimate end consumer. And we all know that the US is still the largest consumer base that everybody wants to penetrate into, and they're just pretty crazy in terms of their spending. So what they're doing now is that, yes, China is exporting to countries like Mexico, Canada, and then after that, from those countries, they then export to the US. So at the end of the day, if the tariffs are being enacted to all their trading partners, so there's no way to maneuver or circumvent some of these policies actions. And overall, if things gets very expensive, the end consumer actually stops demanding these products, then the manufacturing powerhouse, in this case China, whether is it exporting straight to the US or exporting through some of these workabout ways. So let's just get that in mind. And also, regardless of who is going to come out relatively victorious, I think it will still be a lose-lose for the entire world. So I think in recent times, there's a lot of discussions and murmurs online talking about game theory and how number one and number two is just trying to push each other down, and they just want to be relatively well off compared to the other. And if you're going to continue operating with this sort of relative mindset, then we are absolutely all going to lose. So US has also indeed created a great deal of instability, and if we actually cast back our minds to 4 years ago, I think the same storyline came out of China. Everybody was saying that the government was unstable, they called them a dictatorship, communism, etc. Today, I think coming out from the US, it's actually called strategic game theory, 4D chess. What a time to be alive. But with or without today's state of affair, I think China will still have to undergo self-reliance and innovation in the medium to long term. But now it seems like everything, all the timeline has been accelerated to the short term. They now have to find solutions immediately. So I think my own personal opinion, just to share in this very fast developing market, I think in a fast crashing market, most of the stocks in hindsight look like a great opportunity. So this is especially true if you actually use past information, historical data, maybe over the past 5 to 10 years. You look at their historical growth rates, their margins, their valuation multiples, etc., etc. But I think in a dynamic environment, especially like the one we are in now, there are many players, both institutional and retail investors, basically voting with their dollar bill on how they think the next 6 to 12 months will play out. And clearly, with this kind of huge market movements, there are a lot of disagreements. There are people selling down, thinking that it will be a lot worse, while people are also buying back in. But of course, the selling pressure is a lot heavier. That's why we see a lot of these gap downs and big red candles. But I also think that by introducing so much volatility into the markets, there's really no guessing of who is going where. And the only comfort that you can seek is to actually estimate in a reasonable economic environment, not much in the current context of a global recession, tariff, trade war, etc. Just in a general normal environment that we have seen maybe over the past decade, and you take an average, considering the mode of the company, the relationship with their customers, you can kind of estimate a fair growth rate, margin or multiple, and then you get a range of this so-called fair value. But I think the bigger concern or the fearful thing today is that what does a reasonable economic environment even mean, especially with a lot of things changing in real time. So the market is now clearly very messy because they are trying to re-underwrite so many of these moving parts or factors that could or could not potentially hit the real world business pretty badly. And it's all, at best, guesswork for now. So more often than not, you'll start to see more people adopting the sell first, think later approach. So I rather sell and keep my capital first. Once everything stabilizes, then I'll buy back in. And even if it's a more expensive price, I think it's fine. At least I can avoid the downside, which who knows how low can it go. So now, if you do have many stocks in your wish list or shopping cart, I think it's important to not get too distracted. And going back to the fundamentals of stock investing, there are two main functions. Firstly is knowledge, secondly is conviction. So knowledge is clearly knowing what you're buying, understanding the business operations, how they're making money, what are the different risk factors involved. And secondly, conviction, which is more about the mental capacity, courage, being able to weather the storm. So one comes from the head, one comes from the heart or the gut. So you can understand a company really well and you can even be working for the company. But if you were to really ask yourself today, will you be willing to hold onto a stock even after it drops 50%? Then you'll really know whether you can really ride through the waves both up and down. I don't think that there's a best type of investing style, investing strategy, or even DCA method. So I do get a lot of questions asking me, what am I personally doing? What do you think is the best way to navigate in today's market? To me, I really don't think that there's a best way. The best one is just something that you can stick to and to remain consistent throughout. And I would like to re-emphasize that it's consistency that will bring you all the way to the finishing line. So in my previous video, I've refrained from sharing my personal base case expectations of how things will play out in the coming few months, because I actually don't see the upside in sharing my own perspective or expectations here. There is a lot of noise. Both sides of the camp, both bullish and bearish, all have a very strong argument that they are putting forth. But that said, I think for those of you who have already stayed all the way to the end, I would assume that you are an avid subscriber. And I'm doing you a disservice if you're following somebody that you don't even know what's his baseline expectations of view when you see him maybe firing shots in the market or buying up some of these stocks. So I'm personally not in the camp that believe that we are in a multi-year recession to come, unless subsequent developments actually change my mind. So I do see a very strong case where there is a very small window of opportunity for very effective negotiation to take place, and they cannot drag this on for too long. But I think the outcome is really highly dependent on the state actors and how far they're willing to push this. So I don't stand in the camp of ultimate Armageddon and this whole thing just gonna crash until oblivion. And I'm reserving my view against the idea of a stagflation, even though I've seen a few credible reports starting to talk about this idea where even the Fed can release liquidity. If all this tariff and trade war don't subside, then we might potentially fall into a period of stagflation. And I'm not saying that it's impossible. It's just not my base case expectations for now. And this can change. So short term, I think it's really anybody's guess. I think this sort of 90-degree drop will probably have some relief rally in time to come. But since it's to the tone of being self-inflicted, which is this whole Trump tariff discussion, and I think it could be reversed pretty quickly. And I think drawing parallels to China, where back in 2020, there were a lot of discussions around China's self-inflicted wounds of trying to burst the property bubble, I believe that China's situation feels a lot more structural, which takes time for them to sort things out, while US is purely self-inflicted. But I'm not too sure whether the current path is the most optimal way in trying to solve this long-term deficit/spending problem. And for those of you who have been long-time viewers and also investors in the Chinese tech bear market, you survived Chairman Xi. And now we are talking about this so-called democratic, capitalistic, and check and balance system. So I think there's a very stark contrast to be made here. So please note that I think this baseline view do not affect my own personal deployment. I'll still stick to my plan. And the underlying philosophy is, I'm not in the hurry, but I'm also not waiting around. I'm trying to time the bottom too. So my personal feelings is, it's definitely not pretty. I mean, who would like to lose money, right? So I do feel pretty mixed signals internally, because at the back of my mind, I knew that I just lost 30 grand. But I also am excited to continue buying businesses when everyone is scared. I mean, I kind of think that I thrive in this kind of fearful environment. That said, I just have a feeling that we might not have bottomed yet, because people around me still generally feel pretty okay and still have spare cash lying around, myself included. So I'm still deploying, but not everything yet. So I just intend to do it gradually. So I need a more convincing bottom signal and more people feeling like the war is over. That said, I don't want to let my feelings get into the way, so I'm still buying at varying degrees. Stocks will always crash, and these are some of the worst drops of the S&P 500 since 1976. So the average drop here is 14%, so don't stop investing. And when we look at the past 10 market bottoms, we do see some sort of a common phenomenon. They all decline pretty significantly from their peak, and also the forward PE bottom for the S&P 500 ranges between 8 times to even 16 times. So most of them are probably in the range of 12 to 15 times. Right now, I think we are sitting closer to 17 plus 18 times forward PE, and the lowest actually is the 1982 stagflation, and that was at 8x. So that's why I say that I don't want to rule out the idea that in a stagflation scenario, there's probably another 50% to go if you're going to use this indicator of a forward PE bottom. That said, I think I will keep my entire thesis and investing outlook fluid. For those of you especially with still income and your earnings and your side hustle and whatnot, continue staying invested, continue dollar cost averaging in. So just make sure that even in the worst case scenario, you're fine. So that's just my general take. And with that in mind, I'll see you in the next video. And hopefully in 2025, I'll see you guys on the moon. Goodbye.